For over a decade, Kenya was a nation of grand ambitions. Cranes filled Nairobi's skyline, and megaprojects promised a leap into modernity. Vision 2030 was the blueprint: futuristic tech cities, superhighways, and a new railway network to bind East Africa. Projects like the Standard Gauge Railway and a LAPSSET corridor symbolized national pride and hope for economic transformation. The government borrowed heavily, mainly from China, to fuel this construction boom. But by late 2025, the momentum had faded. Construction slowed, and bold pronouncements gave way to cautious reassessment. The era of debt-fueled megaprojects has ended, replaced by a more sober reality. Kenya now faces tough questions. What's affordable? What's practical? What does the future hold for its ambitious journey? The grand vision remains, but it's colliding with economic constraints. Kenya's infrastructure boom was built on debt, with the hope that growth would make repayment easy. But as debt servicing consumed more of the budget, money for schools and hospitals dried up. The IMF and World Bank demanded fiscal discipline, forcing Kenya to cut back on megaprojects. Capital budgets meant for development were redirected to pay salaries and keep the government running. The era of state-funded megaprojects ended abruptly. To keep building, Kenya pivoted to public-private partnerships, PPPs. Now, private companies invest, build and operate infrastructure, recouping costs through user fees like road tolls. This shift marked the end of easy public money and the start of a more complex, market-driven era. The government's role changed from builder to facilitator, and only commercially viable projects moved forward. Kenya's development story had entered a new, uncertain chapter. The LAPSSET corridor was Kenya's most ambitious project. Port, pipeline, railway and highways to open the north and connect to Ethiopia and South Sudan. Today, that vision is fragmented. Only the Lamu-Garissa highway has seen real progress, and even that's been slow. The railway, once the backbone of LAPSSET, is stalled, too costly and risky for the government alone. Now the government courts private investors, hoping they'll fund profitable segments. The Grand Corridor is reduced to a patchwork of disconnected roads and a port waiting for business. LAPSSET's evolution shows how ambition has been tempered by financial reality. Progress is measured by what can attract investment, not by the original master plan. The superhighway dream is on hold, replaced by incremental, market-driven steps. The Standard Gauge Railway, SGR, was Kenya's flagship project, meant to connect Mombasa to Uganda and transform regional trade. But after reaching Naivasha, the SGR stalled, further expansion shelved due to lack of funds and disappointing freight revenues. The government now seeks private partners, but the future is uncertain. Meanwhile, the Nairobi-Mombasa Expressway, a $3.5 billion toll road, is moving ahead under a PPP model. A private consortium builds and operates the road, recouping costs through tolls. No new public debt required. The SGR represents the old, debt-heavy model. The expressway, the new, privately financed approach. While the expressway advances, the SGR remains stuck, a symbol of shifting priorities. Kenya's future infrastructure will be built where private capital sees profit. The story of these two projects captures the profound change in Kenya's development strategy. The age of state-led megaprojects is over. The era of selective, investor-driven growth has begun. Konza Technopolis was to be Kenya's Silicon Valley, a smart city rising from the plains. 12 years later, only the national data center stands. The rest is a slow, phased rollout, waiting for private developers. The government's role has shrunk to laying basic infrastructure and hoping investors will follow. Similarly, the Galana Kulalu food security project, once envisioned as a million-acre breadbasket, has been drastically scaled back. High costs, technical failures, and poor yields doomed the dream of a state-run agricultural revolution. Now, private operators and county-level initiatives have replaced the grand national plan. Both projects show how bold visions can fade when confronted by financial and practical limits. Kenya's megaprojects are no longer about spectacle. They're about what can actually be built. Kenya's shift to public-private partnerships, PPPs, is a complete overhaul of its development model. The government no longer borrows and builds. It invites private firms to invest, build, and operate, taking on the financial risk. In return, these firms get long-term concessions to charge users, like tolls on the Nairobi-Mombasa Expressway. PPPs slow things down. Private investors demand feasibility studies, risk assessments, and lengthy negotiations. Only projects with clear revenue streams attract investment. Profitable toll roads, not rural highways or speculative tech cities. This means fewer, more commercially viable projects get built. The days of launching massive projects overnight are gone. Now every deal is scrutinized for profit potential. Kenya's development is becoming more selective, prioritizing what pays for itself. The government's role is now regulator and partner, not primary funder. The PPP era is slower, more cautious, and fundamentally changes what gets built, and for whom. As 2025 ends, Kenya stands at a crossroads. The era of debt-fueled ambition is over. Now, pragmatism and financial discipline rule. Grand visions are re-evaluated through the lens of sustainability and commercial viability. The risk-essential but unprofitable projects may be neglected, deepening regional inequalities. The opportunity, a more resilient, efficient economy, less burdened by debt. Kenya's challenge is to balance big dreams with hard realities, building smart, not just big. The future will be slower, more selective, and reliant on partnership. Kenya's journey is a lesson. Ambition must be matched by discipline for progress to endure.